Hey, Moon Platoon, we have been bullish on GME for a good amount of time now, but it is worth saying, is it undervalued still? Because this is the point of big, deep effing value opportunities. Is it undervalued? Let's do a full price analysis with the help of some DD fresh from user Juxtapose Life. Go ahead and check out this link, show it some love, show it a big ol' upvote for me, send hi from the Andrew Money channel in the comments, and show this video a little bit of love by dropping a treat for Meatball, a like in the down below so other space apes can find this video, and a subscribe and a click of the bell button if you haven't quite yet. And those are the only two things that you need to do on your side. You let me handle it from here. Too long didn't read. GameStop is undervalued considering its online sales numbers and e-commerce focus. Analysts haven't caught up yet from Q4 earnings report. Add on top of that the hiring of Amazon execs and VPs, and GameStop valuation is about to explode upward. On its current trajectory, $550 to $750 a share is a reasonable price point with or without the squeeze. Oh, not only is buying GME a play on the squeeze, but it's also a deep effing value bet. Fair warning, you'll develop a wrinkle or two if you proceed, but don't worry, I've included charts, right? So give Juxtapose Life once again the love it deserves in the comments. Down in the description, you'll find this link to make visualization easy. And I don't see a boilerplate, but remember, not financial advice. I am not a financial or a legal advisor. This is for entertainment, but to give you guys a very clear understanding of what is a reasonable conservative estimate for GameStop's true value after the manipulation. Just think about that. It's a rubber band pulled back, waiting to go, raring to go. What exactly is it worth now? Let's answer that question. Chapter 1. Make sure to stay until the end because there are a lot of pretty pictures before us here. GameStop's advantage in its transition to online. Let's start with the ugly before we get to the good stuff. Operating loss. An operating loss occurs when a company's operating expenses exceeds gross profits. GameStop has had a fairly significant operating loss for many years now, peaking in 2018 as it faced the challenges all brick-and-mortar stores faced. Theft of sales to the e-commerce giants, the convenience of online downloads, and pre-ordering on the internet. In the last 2 years, this loss has come down significantly, and what impresses me most about GameStop is their cash on hand, currently $635 million. Very few stores with operating losses have that level of cash. Most are in debt and require the sale of shares to float by very rough times. Okay, so once again, this is kind of like how much money it's your like cost of your lifestyle, right? And instead of like the boba and the Chanel purses that you want to buy, this is more like the employees, right? The overhead, we have the resources, we have just general like expenses and how that compares with your operating revenue. Okay, so this is over time from 2017, and this is, remember, before the pandemic, we have seen operating loss start to trend significantly downward, roughly cut in third from over 600 to slightly above 200 now. And this is the key misstep the hedge funds made in shorting GameStop. There has been stigma out there about brick and mortar stores going under, Toys R Us, right? And Sears as examples, feeding frenzies, blood in the water, you get the point. Sharks have been getting more and more bold, reckless in their targeting. GameStop was the wrong target for a very specific reason. It leases its stores. By comparison, consider Walmart needing to reduce stores or Target. They've built massive buildings with parking lots to house their very specific store needs. Huge upfront costs sunk, and they rent or own these buildings under much different contracts. They can't easily get up and leave one of their stores. Ask yourself, how would Walmart leave a store? Who would buy it? How could the investor renting to them turn it into something else? Now that is something I already disagree with. Walmart is a cookie cutter representation of basically anything. I've seen Walmart's back home turn into Home Depots. I've seen entire mom and pop grocery stores turn into Whole Foods. So it's not impossible. It might be difficult to change the very specific ramifications of like the perfect Home Depot. But once again, I think that this is a different story. It's more like that Walmart needs to put together the team in order to procure and sell an entire Walmart store. versus GameStop can just pick up and say, we're not renewing our lease, and that's it. Maybe a city might want to build an expo center on the cheap. Walmart's costs are priced into this. It can't move as easily. Point being, GameStop doesn't owe anything to shut down a store. It simply stops paying its lease and moves all its stuff out. They rent strip mall locations and mall storefronts. This allows them to liquidate stores and downsize with little to no sunk costs. They can also be reposition themselves much more efficiently. This is why we see this fast turnaround in operating costs last year. The major component of operating loss is storefront cost for brick and mortar. News of GameStop closing stores isn't bad news. Remember that. The media will try to sell it as such. It's not necessarily good news either, but it definitely means that at the very least they're not bleeding money in the same way that other larger stores that are a little bit more immobile can honestly bleed. Did I see Dogecoin? I'll cover Dogecoin in just a sec. So chapter 2, digital sales growth. It is clear to everyone at this point that GameStop is looking to move a large portion of its business into the online space. In 2020, GameStop did $580 million in sales online, and in Q4 alone, their online sales represented over 34% of all GameStop sales. GameStop did more in online sales in the fourth quarter of 2020 than it did in all of 2019. Good morning, Big Orange Machine. So here, once again, basically stagnant at $200 million of digital until 2020. This could be a indicator of there are no other options because right now in the pandemic, digital sales are just getting a boost from a lot of natural avenues. At the same time, it's good to see that GameStop is getting their market share, right? 3xing their digital sales, just giving a caveat, a grain of salt to why you might be seeing this boost. So what caused this? Ryan Cohen. He's just getting started, right? It's easy to think that if you build it, they will come, but someone has to build it. Ryan Cohen is the one that is bringing the thunder here. When we see the sales in 2021, first quarter compared to 2020, the trajectory of this massive shift will become even more apparent. We have to look at Chewy's online sales figures under Cohen's project to project what's to come for GameStop in the next few years. Look at that. Now that is bars, okay? We don't need to go to Verizon to get these bars. 2014, 2015, 2016, 2017, from under, if this is a linear scale, from under like $200 all the way to above 3,000. So that's 10x, 12x here. That's right. They grew it from 205 million to 3,500 million, which is $3.5 billion, 17x. So I'm a little off. In 3 years under Cohen. GameStop announced in Q4 earnings report last week that its intentions are, their emphasis in 2021 will be to improve their e-commerce and customer experience, increasing their speed of delivery, providing superior customer service, and expanding their catalog, which helps them bring it to the next chapter in electronics and media sales, right? We're just 3 chapters in, getting close to the finish line. If you have ever wondered where Amazon makes all its money, look no further than the category of electronics and media. In 2020, the company did $120 billion in sales, and 54% of that fell into this category. There are plenty of other players in this space, but only Apple is close to Amazon's market share. So hence, this is a chart to visualize the largest players. Once again, a pie chart. Pie charts. 2020 online electronics and media sales, right? We have Walmart taking 5.5%, Best Buy 7.1%, Amazon at 58.1%, right? So most of the time, you're gonna get most of your electronics from Amazon. Amazon itself projects this space to grow in 34% in the next 2 years, meaning roughly $40 billion in new electronics and media sales will emerge in the online space for these companies to grow over the 2 years, and we're projecting that GameStop is positioned to grab onto this space and shake Amazon's growth models for the next 2 years, right? So I would love to be able to start getting all of my electronics from GameStop if they can reposition themselves accordingly. That would be absolutely amazing. People are asking about the 3.5 trillion sell-off. I'll cover that in a sec again. What is GameStop worth? Valuations are a funny thing. Companies are only worth what people think someone else will pay for it in the future. Often we start with fundamentals, but in the end, hype and excitement over growth and continued growth leads to higher and higher valuations. Let's start with a simple comparison just to prove a point. GameStop and Roblox, we're all gamers here, right? We know what Roblox is, right? Two completely different companies, but let's look at the figures anyway, and then we'll get back to comparing GME and the online retail giants. Roblox did almost $1 billion in revenue in 2020, and its valuation rose from $4 billion to $36 billion. Why? Well, it went public, right? IPO is a great way to hype a stock. People get excited, maximize valuation, so those angel investors can finally get paid. So how does this compare to GameStop minus the hype of the IPO? Well, GameStop did $6 trillion in revenue in 2020. Yep, 7 times what Roblox did. So why the major difference in market cap? Well, for one, Roblox has very few employees and no stores to spend money on, right? If GameStop were valued the same as Roblox right now, it would move its price to approximately $5,000 a share. That's not a squeeze number. That's simply an IPO, a hyped valuation number on growth. Well, GameStop is moving in that direction minus the IPO, but they're aiming to grow. So this is a very bullish hypothetical, and I would say there's multiple reasons why we cannot compare the two. But as of right now, I think they put a couple of caveats on, so just be aware that they are still being conservative. They're not trying to say that GameStop is worth $5,000 a share based on this fact alone. Price and sales ratio, right? This is so important. Look at this: Apple, then Amazon, then Chewy, and GameStop follows closely behind. Whereas we have the larger stores here, very cutting the deepest prices here, and their sales are compared to their prices, cutting the bottom floor for Target, Walmart, and Best Buy. So let's get a better comparison to the other giants. They've chosen these because they represent a wide range of brick and mortar versus e-commerce. Price to sales ratio is calculated by dividing the market capitalization by the revenue. This gives a general sense of how much the market is going to value the company relative to its revenue. Value players like Buffett are often looking to the lowest PS ratio to enter a fundamentally solid company, and companies with a lot of growth potential and hype can grow their PS ratio to levels that are very high. One thing you'll notice in this chart, the more online the company is, the higher its PS ratio can go. This directly impacts the valuation of the company. While companies that may be online, they still rely most heavily on their stores, have a lower PS because they have a lot of overhead costs. You'll notice GameStop in the middle because it's transitioning to e-commerce. Last year, you would have to see GameStop with a PS similar to Best Buy and Walmart. The reason for this is important because GameStop is growing as an online business. So once again, this is just another indicator that matter to major investors like Buffett. We are seeing GameStop transition slowly from the Targets, Best Buys, and Walmarts of the world over to the Apple, Amazon, and Chewy's of the world. Final chapter, conclusions. So you've been patient, and they told you that they'll get to what GameStop is currently worth, next year's projection. So what is it worth right now? $191. That's still the case in pre-market. It looks like it's up to $193. It's only worth more when people see the numbers and get excited about them. The numbers show that GameStop is growing exponentially with its online sales, and Ryan has brought on a team to accelerate that growth. They don't know what Q1 numbers are, but they can guess a lot of apes are really excited about GameStop and becoming more and more loyal to its brand. They know they won't buy anything from Amazon, and they could get a lot from GameStop right now, even if it costs slightly more. It's because of quality and support for the brand. Lots of things are increasing GameStop's valuation, but growth of its online sales will be the most significant one. What most analysts are ignoring or simply missing is how massive GameStop's online sales growth was last year, right? It's about acceleration and velocity. How fast are you growing based on how much you were doing last year? And then how fast are you growing in the derivative of that velocity, right? That will tip PS higher and higher, and people will stop seeing GameStop as a failing brick and mortar and recognize it for what it is, an Amazon killer, going after an $88 billion market in electronics and media by 2023. On top of that, growing an esports brand that will engulf a $200 billion annual industry that will likely grow to $300 billion by 2023. In 2 years alone, we're likely to see a 50% growth in this space. Project these figures in the GameStop as you'd like, and I'll take a stab at it. Right now, GameStop would be valued at $662 a share based on its Q4 figures and projection into 2021 from its finish in 2020 Q4. By this time in 2023, we will see GameStop at a $50 billion valuation from $12.5 billion in sales and a PS in the 4.0 ballpark. That puts it at a share price of $795 conservatively without hyper on the growth. right? How do we justify a growth from 580 million to 12.5 billion in 2 years? Ryan Cohen. Multiple current sales are 17. Go back and look at that Chewy graph if you wonder how that's possible. There is a gaping hole in the electronics e-commerce side, and once again, this is a quite bullish, even if it's trying to be conservative estimation. So as a final thought, if you needed one more reason to hodl, it's this: you'll be at least 4 times richer in a few years from now, even if you went into a coma and your wife's boyfriend lost your password and couldn't get that sell button on the way down from the squeeze, because at 191 a share, GME is a deep effing value play aside. Well, now that you guys have gotten a clear understanding of the growth, the transition from GameStop from brick and mortar to e-commerce, and exactly the track record that Ryan Cohen has had with Chewy, can we use these numbers to project GameStop's true pre-squeeze, regardless of the squeeze, independent of the squeeze price? If you think so, then drop a comment down below of how much you agree, whether or not you think this is still an underestimation, and whether or not you believe that GameStop is an Amazon killer. Thank you for those of you who've supported the show all along, right, by pressing that join button like these guys have, down by the subscribe button, and thank you guys for going on to Patreon and supporting me there. For now, but not for forever, I'm going to readjust my camera, and then I'm going to see you in the money.